welcome Tara Davies from KKR to talk about the landmark transaction, the KKR BlackRock transaction that was concluded this year.
Hi, Mark. How are you?
How are you? Thank you. So I have a feeling of déjà vu. We've been here before, but now we can just focus on you. This was in the annals of infrastructure transactions. In some ways, it was a very conventional transaction, but for the Middle East, it was a landmark transaction. Tell us a little bit about how you thought about this, because you did it obviously as part of a bigger group with BlackRock, and how that potentially changes your thinking about the region, if it does, so that we can try to weave together a scenario of what's likely to happen in this space.
Sure. So this is KKR's first investment in the Gulf region, and we had looked at a number of opportunities across a variety of sectors, so not only infrastructure in the past. But this transaction was kind of structured that really worked for kind of international capital, which is backed by pension fund money. And what is kind of a very important part of the infrastructure thesis that we have is partnering with global companies who are kind of best in class. And we can take minority or majority positions in those companies. But the key is, if they're operating the assets that we're investing in, we want them to be, best in class. So, for example, in the telecom space, we have a joint venture with Telefonica. We have a joint venture with Acciona in the renewable space. And when we came to kind of partner with ADNOC, we realized that ADNOC is obviously best in class in everything it does. And so in this transaction, we don't actually control day-to-day operations. So there's a lot of trust put in ADNOC as a partner to deliver what we've structured within the deal. So the partnership was very important. The fact that the governance is kind of a classic international governance package. Our partner in BlackRock is also kind of a high caliber partner who we've worked with before in the States. And then the structure of the deal allowed for our type of capital to invest. And in the infrastructure space, we have a dedicated infrastructure fund. And what we look for is, in essence, capital preservation. So we ask ourselves one question: what happens when everything goes wrong? Do you get your money back and a small return? And if the structure of the kind of contract or the privilege of the assets or the market protection that exists delivers us that in a downside scenario, for us that's infrastructure. And this deal was structured on an iterative basis with ADNOC. I think you had particular objectives you wanted to achieve in delivering that deal. And so did we, and we worked over a number of months to kind of satisfy your objectives and satisfy ours. So I think these aren't cookie cutter, though they seem very simple when they go to market. It is a kind of long process of understanding what works for both parties.
So maybe you can describe a little bit the structuring which involved SMBC being the lead bank. So if you think about it from the standpoint of ADNOC, every institution has a weighted average cost of capital. So any asset that is a trapped asset, which essentially has a stream of returns which is significantly below your weighted average cost of capital, should be released, right? And then you should be taking those returns, taking that cash, and reinvesting it in the much higher margin businesses, which is your domestic upstream operations. This is exactly what we've done. We take that low yielding cash flows, sell them in the market, and then we reinvest them in oil and gas, and that's what you're supposed to do. But you did something interesting. You took that flow from us, and then you used the banks to give yourselves a better return. Yes. By leveraging it, and you also protected yourself because your funds are of a certain duration, and then these are all variable tenors, so you kind of pull this all together, if you can describe that.
Sure. And I think the interesting thing about ADNOC is you've got a good feel for the risk profile in your business. So, obviously upstream's higher risk, you've got the retail, you've got the midstream assets. And what you've done very successfully in this transaction, in my view, is actually matched the right asset profile with the right equity. rather than taking a holistic view across your business. And so you've kind of attracted the right cost of capital. It's obviously you achieved kind of a good whack for that deal, in my view. That whack was probably a bit low in terms of the return that we wanted. The asset itself is ungeared, and what we put in place at the holdco level alongside BlackRock, where we used SMBC, was a layer of debt. And that layer of debt is a kind of, long-term soft mini-perm structure, which will amortize over time and then layer our equity on top. And given the kind of, privileged volumes that we see into the future, what we see in a downside scenario is all the debt will get paid back, our equity will get a small return and be paid back as well. And then we will get a return on top of that, which is a little bit higher than the ADNOC WACC because we've actually geared it in between. But that's actually at the holdco level and a kind of structured deal that we've seen in a number of international markets.
So in theory, we could have done that, but then we would have had the debt on our balance sheet. But this way, it's not
off
there.
Balance sheet.
Tell us a little bit about the trajectory of interest rates, if that would have an impact on your transaction. And if so, have you done anything to mitigate the potential impact, including refinancing risk?
Yeah, so interest rates are a funny crystal ball gazing, Mark, because at the beginning of the year I was absolutely certain they were going up, and of course they've come down all year. So I'm not a great person to ask about interest rates. But from an infrastructure perspective, because we have this kind of downside protection view on the world, actually interest rate risk is something we focus on a lot. And so in the ADNOC deal, we hedged our rates over the long term, so have very little interest rate volatility. And had we not, we'd obviously be facing kind of refinancing risk. Now, in this current market, that would have been to our benefit, fastly, but actually we'd prefer to protect the capital and deliver a spectrum of returns which our investors prefer, rather than kind of giving them private equity style returns or higher returns just because of the whim of the market. So I think we do look at kind of inflation as well, which is obviously the quid pro quo to interest rates. Not all of our deals are inflation protected. The ADNOC deal one isn't, but that also plays into our toleration for refinancing risk as well.
So the refinancing risk, you don't have the then refinancing risk because what is the tenor of your funds and what was the tenor of the transaction?
So we've got a 15-year fund, and the tenor of the transaction's 23 years, and we can in specie distribute the ADNOC deal to our LPs to the extent we don't exit in that lifetime.
So if you're not able to refinance it, then you can essentially return the fund in kind?
Yes.
Okay.
Yes.
And can you tell us a little bit, I'm not asking for names, but just tell us a little bit about the kind of investors that were in the fund, because ultimately I think a lot of them were first-time investors in Abu Dhabi, which for Abu Dhabi was a big accomplishment.
Yes. So our fund investors are a broad range of investors, from insurance companies to pension funds, to kind of sovereign wealth funds. They are global by nature, so that a lot of our fund comes from Asia, a lot comes from the US, and a small proportion in Europe as well. And they're investing kind of pension fund money, which is why they like an infrastructure product. And so they'll be, your firefighters in New York or your teachers in Canada. So they're everyday people like us who will have a very small portion of that fund and therefore that investment.
So these are global investors. Mm. And how big is your overall infrastructure portfolio?
So we have 18 billion under management globally across 3 funds. And yeah, this is our first investment in the Gulf region across the funds. And given the kind of great interaction we've had with ADNOC, and it is a partnership that we kind of have enjoyed the deal on, and actually are getting kind of closer to in terms of the asset management of the asset. Hopefully, we can do more in the region.
So you were before at Macquarie, which is one of the pioneers in infrastructure, but you never looked at the region from that standpoint. Is that correct?
That's right. We didn't really look at the region.
And you only invested in Asia and I guess in
Europe and America.
Europe and North America. Okay. Given that you've opened the door to the region, presumably there are more things. I know we're working on another transaction. Obviously, we're aware of that. But are there other things that you're looking at in the region? And what, not only just copycat transactions, which people love, but is there anything else that sort of makes it interesting?
Well, Mark, I think there will probably be a copycat transaction.
Okay.
But I think it has opened people's eyes to, other ways of monetizing. So, we've seen privatizations, we've obviously not seen IPOs, so there's obviously different ways of bringing capital in. I think the interesting nuance with ADNOC is ADNOC didn't need the money. ADNOC obviously wanted a good deal and got a good deal, but also kind of was looking forward and looking at how it would evolve its business in a 2030 strategy. Sometimes when people come to the market, they just want the money. They haven't thought about how you structure the regulation when it's inextricably linked to the government, and you're trying to privatize that asset, and things like that that are actually important to international capital. So I think there are people who have looked at your transaction and thought there must be ways to monetize, and I think that is absolutely correct. I think for international capital, I think they need to be well structured, and I think the governance in place needs to look like a market standard deal. And I think if that is the case, I think it will, there'll be more to come in the region in different structures as well.
So you work for a very famous private equity firm, but you're in infrastructure. So I don't know if this is correct characterization, but infrastructure is a more tame version of P. So the P guys are the more crazy guys, right? So you're more tame. But what I'm trying to get to is dealing with a national oil company or dealing with a large state oil company is different to a certain extent, but probably analogous if you're dealing with Thames Water or a power company. So were there differences there? Because I'm going to ask you next if aren't you doing these similar transactions with the Exxons and the Shells and the BPs, and why not if not? So it's a two-part question. Sorry about that.
No, that's fine. So I think ADNOC's vision for the future was amazingly clear. So I went to the ADNOC Investor Day, not this year, but last year, and when the 2030 vision was kind of announced, I could see what ADNOC was trying to do into the future, and then I could try and work out how my capital, or any pool of capital in KKR, whether that's credit or private equity or whatever it may be, could be relevant for that strategy. I think sometimes with other companies, if that strategy isn't clear, it's hard for me to engage with them in a way where I think my capital's being relevant to their objectives. And if you can't have that level of conversation, I think it's very hard to kind of structure deals and come up with solutions for both them and us.
Okay. And on the international oil companies?
And on the international oil companies, we do engage with them. I think we've bid on assets, from them in the past. Interestingly, there's nothing in our portfolio. So whether it's we haven't been successful in a competitive auction or we just haven't kind of managed to get a very strong relationship with them, it could be a bit of both. But we don't have any in our portfolio. Interestingly, with the international oil companies, we tend to compete with them most in the renewable space at the moment because they've all kind of created new energy divisions and trying to kind of pivot away from the oil market, buying into, kind of big, and they need big because nothing moves the needle, big renewables projects, which, we've been in and around.
Kind of an out-of-scope question. The big oil companies getting involved in big renewable projects that have very different IRR profiles. When you think about that and to work with them, does that kind of befuddle you, or do you wonder if that's consistent? Are they able to do that, or you're just looking at it as a number and it doesn't really matter?
The renewable space is an interesting one because it started in an era like kind of 10, 15 years ago when the prices were very high and feed-in tariffs drove the sector, so government subsidization. In the past 15 years, the cost of actually putting renewables in the ground has decreased substantially, and actually there doesn't need to be any subsidy anymore. And what there needs to be is kind of contracts, which are commercial contracts, which are negotiated with parties. And in that construct, in my view, the winners in the space are those that are very fast, very quick, and very nimble. And I'm not necessarily sure that very big bureaucratic organizations are actually the best competition to be the winners in that space. So we are invested in that space. Actually, we've backed a developer, which is a small company, actually, and they're kind of growing organically rather than kind of buying big.
So I think you stole the show, actually, because that point is something that a lot of people have talked about. Are large engineering-based companies capable of being agile? Agile is a word everyone uses often because they like it, right? You always want to be agile. You don't want to be lethargic. But that's complex. So you've left us with a lot to think about. So thank you very much.
Thanks,
This was
Mark.
great. Thank you.
Thank you.